It's been an eventful week in markets since our last podcast. The FTSE 100 and other world markets have been in quite sharp decline. So having got towards the top end of the trading range, in the last 7 days the FTSE has lost quite a few percent, nearly 200 points, as we can see from the chart here. Here we can see the sort of top end of the trading range that has been in place for the FTSE since really the beginning of 2011, and having got towards the top end of the trading range, Monday morning equities have generally been in quite sharp decline, back down to sort of middle area of this trading range. Two things are going on which are influencing markets at the moment. The first is obviously Europe. Europe still maintains its position as the dominant theme for investors. I'm putting up here the chart of the Italian bonds. This is the yield payable on Italian bonds, so this is the cost that the Italian government have to pay to refinance a lot of its debt. And as you can see here, just at the end of June, the cost was around 5% yield. It's 6% as we move into July. So Italy has become centre of the scene. They did hold an Italian bond auction this week, which went relatively well. There was good demand, but to put it into context, it is costing them, as I say, a good deal more to refinance these bonds than it would have done just a few weeks ago. A front page comment on the Financial Times described the current rate of interest as unsustainable or untenable for the Italian government in the longer term. So real stress still being seen right across Europe. If we also look at the other major economy, which we've always had concerns about, and that is Spain. Again, I've highlighted this before, but worth just updating where we stand today. This top end of the range for cost of refinancing Spanish debt at 5.5%, quickly breached 6%. It has shied away from there, but we're still really at the top end of that range, and this is definitely weighing on sentiment towards the Spanish market. A key test next week with Spain is the flotation of two Spanish banks, which I think will as I say, show how comfortable investors are backing Spanish banks and in new flotations, in raising more capital at the moment. Now that's the negative. I think it's worth highlighting the positive developments that are taking place in markets. I've been talking about corporate earnings for some time, and the start of this week heralded the beginning of the second quarter reporting season for companies in the US. To put this into context, we're expecting to hear from 498 companies over the course of the next couple of weeks. This week we started with Alcoa on Monday evening, and so far we've heard from just 9 of those 498 companies, but pleasingly 7 of those have beaten expectations, 2 have missed. The 2 that we've seen missing have been in the chip manufacturers, but generally companies such as Google, where we've got a chart here on Google, JP Morgan, Capital One, have all exceeded expectations. Google was probably most interesting out of that group. They beat expectations by a good margin at all counts: revenues, profits, earnings per share, etc. And whilst it cannot be reflected on this chart because the move took place after the close of the US market last night, the share price increased by about 11% on the back of those results. So we should see that coming into this chart over the course of the next few days. So as I say, really 2 things here: European contagion creating the negative sentiment, corporate earnings, as I say, starting in the US at the moment, pleasing on expectations at the moment. Turning to the UK, a couple of stocks to highlight. Not that we have any particular view on it, but I think it's worth mentioning. This is a long-term chart of Burberry, the luxury goods manufacturer. We're going back here to August 2010, so it's a year chart, and really, as you can see, it's been an impressive performance from what is a FTSE 100 listed company. Results this week highlighting that Burberry sales continue to do very well, particularly in the Far East, and really a recognition of what the theme we've been trying to talk about is well-positioned businesses who can expose themselves to the Far East, and how well their share price is performing despite a lot of what we talk about when we talk about negative sentiment on markets. Just one or two things to focus on. in terms of the look ahead. The US, by August the 2nd, has to resolve its debt ceiling issue, and this is obviously a tremendous political debate at the moment as to what austerity moves need to be agreed to get the full vote for increasing the US debt ceiling, and this is going to become an issue, I think, more relevant to markets in the short term up until that August the 2nd issue, because it doesn't look like it's been resolved at the moment. I will just highlight, however, that the US dollar is generally behaving itself. It is weak at the moment, but has been strengthening slightly against the euro over time. So I don't think markets are becoming too stressed at this stage. But of course, if we get towards that August the 2nd deadline without any signs of a resolution, then that is something to look ahead as a potential negative sentiment to markets. Just finally, finishing off with a couple of stocks from the UK to focus on. Obviously, the whole situation regarding News International and B Sky B. This was the result of the withdrawal of the bid there, taking that stock right the way back to levels last seen prior to the bid launch last week. And finally, on Barclays, I'm going to mention just that the banking sector still remains in pretty poor shape across Europe, even in the UK here. Barclays back down to a low for the year now, on concerns over these European contagion issues and what impact that will have on the banking sector. So still under pressure there.